The foreign earned income exclusion sounds like a simple deal. Americans living abroad can exclude a big chunk of overseas salary from U.S. federal income tax. For 2026, that number is $132,900 per qualifying person. A married couple where both spouses qualify can exclude up to $265,800 combined. That's real money. And it's one of the most searched tax topics among U.S. expats because the headline number is easy and the rules underneath are not. Here's what the exclusion actually is, who qualifies, and the mistakes that turn a tax benefit into an IRS problem. First, what FEIE is not. It is not a blanket "I live abroad so I pay no U.S. tax exemption." It does not apply to investment income, dividends, interest, capital gains, rental income from U.S. property. It does not apply to U.S. source wages. It does not eliminate self-employment tax on its own. And it is not automatic. You have to elect it every year by filing Form 2555 with your Form 1040. What it does cover is foreign earned income, wages, salary, and self-employment income for services performed outside the United States, up to the annual limit. For tax year 2026, the IRS limit is $132,900. If you earn $90,000 abroad and qualify, you may exclude all $90,000 from U.S. federal income tax. If you earn $160,000, you exclude up to the cap. The excess remains taxable unless other rules apply, like the foreign tax credit. Second, who qualifies? You need three things working together: a tax home in a foreign country, generally where your main place of business or employment is located; foreign earned income, not passive income, not U.S. work trips that dominate your year; and one of two residency tests: the physical presence test, 330 full days in foreign countries during any 12-month period, or the Bona Fide Residence Test. You're a genuine resident of a foreign country for an uninterrupted period that includes a full calendar year. Different paths, same destination, but the day counting is strict. A miscounted travel day can disqualify you. Third, the housing piece people bundle with FEIE but confuse as the same thing. The foreign housing exclusion or deduction is separate math. For 2026, the base housing limit is $39,870, with higher caps in designated high-cost cities. Qualified housing expenses above a base amount can be excluded or deducted, but only if you already qualify for FEIE, and only for amounts that exceed a calculated base housing figure tied to your qualifying period. Tokyo and Topeka are not the same calculation. Now the mistakes, because this is where expat forums get expensive. Mistake 1. Assuming FEIE beats the foreign tax credit without comparing both. If you live in a high-tax country, Germany, Japan, France, the UK, the foreign tax credit often saves more than the exclusion because it reduces U.S. tax by taxes you already paid abroad. FEIE and FTC interact in complicated ways. You generally can't double-dip on the same dollar. Many expats pick FEIE because the number looks bigger and overpay U.S. tax for years. Mistake 2. Forgetting self-employment tax. FEIE can exclude your freelance income from income tax, but Social Security and Medicare self-employment tax may still apply on net self-employment earnings unless a totalization agreement covers you. Digital nomads billing U.S. clients from Lisbon are not automatically free of SE tax just because FEIE exists. Mistake 3. Missing the filing deadline extensions expats rely on. U.S. citizens abroad get an automatic 2-month extension to June 15th and can request further extension to October 15th, but any tax owed still accrues interest from April 15th. FEIE doesn't remove the requirement to file. Mistake 4. Revoking FEIE casually. If you elect the exclusion and later revoke it, you generally cannot claim it again for 5 years without IRS approval. Switching strategies year to year without planning can lock you out. Mistake 5. Ignoring state taxes. FEIE is a federal provision. California, Virginia, and several other states do not automatically follow it. You can exclude income federally and still owe state tax if you're considered a resident there. A common surprise for "I moved abroad" stories that never formally cut home state ties. Mistake 6. Proration confusion. If you only qualify for part of the year, the exclusion limit is prorated by qualifying days over 365. Move mid-year without planning, and your cap shrinks proportionally. There's also a broader structural point worth understanding. FEIE was designed for Americans earning a salary abroad: teachers, engineers, aid workers, corporate assignees, not as a universal nomad tax hack. The rise of remote work blurs lines the rules weren't written for. Where is your tax home if your employer is in Texas, your body is in Mexico, and your clients are global? Facts and circumstances matter, and gray areas belong with a professional, not a YouTube comment thread. So here's how to think about it practically. 3 questions before you assume FEIE is your answer. 1. Is my income actually *4 earned income from services abroad? Or is a meaningful chunk U.S. source, passive, or capital gains? 2. Do I pass the physical presence or Bona Fide Residence Test with documentation, passport stamps, lease, employer letter, calendar of travel days? 3. Compared to the foreign tax credit which method saves more over 3 to 5 years, not just this April? Quick recap. The foreign earned income exclusion for 2026 tops out at $132,900 per qualifying person, $265,800 for 2 qualifying spouses. It covers foreign earned income only, requires Form 2555, and demands a real tax home plus a residency test. It does not wipe out all U.S. tax obligations, does not cover passive income, and does not replace careful comparison with the foreign tax credit. Housing exclusions are separate. State tax may still apply, and the exclusion is powerful when used correctly and costly when treated like a magic live abroad checkbox. If breaking down the real rules behind expat tax headlines is useful to you, subscribe. See you in the next one.